And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. ETFs are having their biggest year ever. Record inflows, record assets under management. But are they in any danger of being overtaken by a new technology? The blockchain. Let's talk about that with Nick Cherney. He's head of innovation at Janus Henderson Investors. He also runs their ETF business. They are set to take over a short-term treasury fund and begin trading it on the blockchain, bypassing the usual ETF route. Also joining us, my old friend Todd Sohn, ETF and technical strategist at Strategas Securities. Nick, tell us about this. Janus Henderson is the latest large asset manager to start experimenting with what's called securities tokenization. Tell us what this is, what are you doing with this fund, and how might this affect the ETF business?
Yeah, thanks. I mean, look, at its simplest level, tokenization is really just about taking any kind of asset from the traditional financial world, in this case a fund, and making sure that it can be transacted on the blockchain. So I think a lot of people really think about, Bitcoin or other cryptocurrencies, and that's one aspect of what can be done with blockchain technology. But from our perspective, one of the really interesting things that you can do is take a traditional fund, right, in this case a treasury fund, and ensure that it can be transacted on the blockchain. So you have all the traditional features of a fund, but where an ETF might be traded on a brokerage platform, now you're able to buy and sell it on a blockchain-based platform. And that really opens up a huge number of things that aren't possible today with traditional funds or ETFs.
Yeah, so I want to make sure viewers kind of get this idea, because potentially this could be potentially revolutionary. So with tokenization, you're converting an asset, in this case it's a treasury fund, into a digital token that can be stored and transferred on a blockchain, and you're not even bothering to turn it at all into an ETF. Tell us about what's the advantages to doing this. What's the advantages for you and for the investor?
Yeah, I mean, those two things are really closely aligned in this case. I mean, for us, the advantage is just that we think there are potential benefits to the end investor. And there's a number of things. I think at its simplest level, the way to think about it is that traditional asset managers like us, what we do is we have investment insights, right? We provide professional investment management services, and we want to get those services and those insights into the hands of clients. Well, most products, there's a lot of steps between those two things, right? There's a lot of people who stand kind of between us and our clients, and all of those steps take time and money, sort of operational complexity. And blockchain has the promise, I think it's a promise a little bit still out in the future, but it has the potential promise to really collapse all of those things pretty significantly. And what that means for the end investor is kind of instantaneous 24/7 trading, instantaneous settlement, total transparency over fund holdings, so even beyond what ETFs provide, right? Real-time transparency. And then one of the really interesting things, I think, is this idea of programmability. And what that means is that you can use a fund like this, or any asset really that's on the blockchain, as part of an automated transaction. So that might be, for example, something simple like a contract, right? So if you think about in the real estate market, for example, the possibility for things like title companies to kind of not really need to be there, and those transactions could happen entirely contractually on the blockchain. Or in the case of sort of traditional funds like we're talking about, things like collateral management, right? Or treasury management, or instantaneous access to cash management, right? So there's a lot of these potential applications. And what we're trying to do is really be involved in the early days of this, right? It is still very early. It's a very small market today. But if we're here today, we're hoping that we can kind of learn and grow with our clients and really be leaders as this future sort of develops over the next 5, 10, maybe even 20 years.
I want to bring in Todd and get his thoughts here. This is one of the things about blockchain that I find very exciting. I've been very public before. I'm not terribly excited about Bitcoin, which runs off of the blockchain. It's a cryptocurrency. But here he's talking about, for example, in the future, settling real estate transactions on the blockchain. You could even do settlement, stock settlement on the blockchain. You can send money to your friend in England without having JP Morgan and everybody else get in between. And in this case, you can actually take a fund and create tokens around it and trade it on the blockchain. Is this any threat to the ETF industry?
I don't know about a threat necessarily. I mean, it is very early on, as Nick just said.
Yeah.
But I wonder if this is how you start to get more of those private assets up and running in a better, more efficient market than what we're trying with ETFs right now, where you're jamming illiquid assets into a liquid wrapper. So there's that side of it. I like the opportunistic attitude of saying real estate, private equity, whatever it is. The cynical part of me is, though, 24/7 trading makes me nervous.
It should.
Right? So that's the one part where I'd want to be a little bit careful, depending on who is using this. Maybe it's not going to be the older demographic because they probably don't understand it, but there's going to be some folks who get tripped up trading 24/7 at 3 in the morning.
Yeah, I don't think we need 24/7 trading myself. That's a feature I can do without. But let's keep talking about this, Nick. I know BlackRock, I know Fidelity International, I think Franklin Templeton. They're already running tokenized treasury or money market funds on public blockchains. You're looking to join them. Tell me about the cost. What kind of cost do you eliminate when you go to decentralized blockchain? It sounds like you're going to cut out a lot of staff here. There's a lot of people that support the ETF business, staff people, and you think essentially this will help reduce the staffing, which will help you sort of compete on the cost basis better, right? It sounds like that.
Yeah, I mean, look, that's the over the long term, what you should be able to do is create increased efficiency. I mean, here's a simple example. It wasn't that long ago, all of us on this call remember in our careers, where there was a very profitable industry around printing 600-page long prospectuses and delivering them overnight for bankers in New York, right? That whole industry doesn't exist anymore. Right? It just makes no sense to be carrying around reams and boxes full of physical paper. There's a lot of analogies that exist today in finance, and I think I would agree with the comment that was made that it's not necessarily a threat to the ETF industry. I think it's more of a natural evolution of how we try to get the way in which we deliver investment services to clients to be more efficient and less costly. And we've just seen, a rapid decline over the last 30 or 40 years in the costs of delivering and accessing asset management services, and this is just that next step. So I mean, it's very early today, but it's rapid growth, right? In the last year,
Nick,
the amount of assets has gone up by 4 times.
Why isn't it a threat to the ETF business? You're announcing a fund here that you're not converting it to an ETF, right? You're going right to a tokenized, blockchain structure. Why? To the extent that in the past you might have taken that fund and turned it into an ETF, and now you're not. Why isn't it a threat? It seems to me like it is. Maybe not this year, but 5 years, 10 years, certainly down the road. It seems that way to me.
Yeah, no, it depends upon the perspective, right? So as an asset manager, we don't view it as a threat. In the same way that we don't view our ETF business as a threat to our mutual fund business, we view it as an evolution. At the core of what we deliver isn't so much product wrappers as it's investment advice, and we want to deliver that in the wrappers that our clients want to have access to. So I think from the perspective of an asset manager, it's not really a threat, it's an opportunity, and we want to be early in that opportunity. I think there are certainly people in the ecosystem for whom it's potentially threatening, but you see those players getting involved. So for example, the DTCC, which is arguably the most significant financial infrastructure in the world, made an acquisition to think about how they can bring their business on chain, right? So a lot of those types of players who, I think the average consumer doesn't really pay much attention to, custody, clearing, those types of really important services, I think what's going to happen is they really need to think about how they're going to deliver tokenized solutions, and because otherwise they will be disrupted. But for us, what it means is faster, more efficient, less expensive delivery of our services to clients. But 20 years from now, it may mean that ETFs are less important, just in the same way that mutual funds today are, less important than they were 20 years ago compared to the ETF wrapper.
I don't think it's going to be 20 years. First off, those of you who don't know, DTCC does all the settlements. They're essentially the structure, the organization that handles settlements in the United States. Nick, of course, is a fund manager, and he has to be agnostic on the platforms that he provides this, so mutual funds, ETFs, tokens. So to him, it doesn't matter. But the ETF business is a threat to the mutual fund industry, clearly.
I mean, this sounds like, forget a threat to ETFs, what about a threat to mutual funds more broadly?
Yeah.
Especially the retirement system too. I mean, can you get that on chain and change the whole structure of that, right? There's $40 trillion now in retirement assets across the US, so that's a lot of money too for this structure to take aim at.
Yeah. Well, I think you would agree, though, this is very early on, but in the long term, this can replace an ETF structure in certain circumstances, right?
I'm, as an ETF person, a love of ETFs, I don't want to see it happen too quickly, but you have to adapt, or we know how things go.
Yeah. I want to move on a little bit, and Nick, jump in here. I wanted to ask Todd about where we're going in the ETF business right now. The S&P 500 at an historic high. We have had huge inflows this year into ETFs. We might have a $1 trillion year inflow, biggest ever. We got $10 trillion in assets under management. I want to get your thoughts on this rally. We've had a great move up in all of these cyclical sectors. Consumer discretionary is at a new high. Industrial stocks are a new high. Material stocks at a new high. Interest rate sensitive sectors like REITs and utilities are near new highs. This is not the kind of stuff that is at a new high if investors think the economy is going into a serious downturn. That's why I'm still relatively bullish. Nobody's going to be buying this stuff if they think there's an imminent downturn.
You think you have to be? I love the idea of going back the last few years and remembering anything that was not tech has been in a bear market since late 2021, early 2022, right? And that's a lot of these cyclical sectors that are finally moving. You haven't seen many inflows to these sector ETFs, which I really am a fan of, because that tells me positioning is not too aggressive. And until I start to see staples outperform and credit spreads widening, right, real simple stuff, it does not mean, as you just said, it doesn't mean that the market is worried about any economic undertones yet.
And we saw staples do a little better early on, but now they're being overtaken. So consumer staples have been lagging recently. Healthcare's been lagging. Energy's lagging, but tech's also lagging a little bit, and nobody seems overly worried. It's not lagging much.
Yeah.
But nobody seems overly. There's a little bit of a correction in semiconductors going on, but it's not dramatic.
Yeah, the key part being it's a change in leadership, that financials are leading, real estate's leading. Tech is now leaving that leadership frontier. I'm okay if tech takes a back seat in terms of leading, as long as it doesn't start to go down. That's the big difference, right? It can rise with the rest of the market and not be a leader. That's totally fine. It's when that influential weight declines as the rest of the market goes up that you may get some sort of problem going down into 2025.
Nick, you've been in this business a long time. Give us, and you're head of ETFs at Janus, give us your thoughts on what you think is going on here. Do you agree with our point here? The market seems to be interested in cyclicals. That seems to be supportive of at least a soft landing in the economy. But your thoughts on what we're doing this year?
Well, I mean, the part of this that is amazing to me, I mean, obviously we just had a pretty significant rate cut for the first time in a long time. And it's interesting to me to see that when we're hitting all-time highs, there's a conversation about what does that mean for ETF adoption. When the markets sell off, we have similar commentary about what does that mean for ETF adoption. When rates are declining, when rates are being rising, it seems that no matter what the kind of macroeconomic drivers are, there's always an explanation for why that's going to feed ETF growth. And the reason is because it seems to. We seem to just be in a situation where kind of regardless of market conditions, we just continue to see this exodus from traditional fund assets into the ETF wrapper. And that to me is, really we've kind of hit the tipping point in the last couple of years where it's almost just regardless of what's going on. And there was a comment made earlier about the generational aspects of that. And I think that's true, right? We just are at a place where younger investors overwhelmingly prefer ETFs. Maybe in another 10 years, they're going to overwhelmingly prefer, blockchain delivery, but today it certainly is ETFs.
He's got a point, win or lose. It's sort of like win or lose. You still get inflows into ETFs.
Yeah.
Weak year, you'll get inflows into certain other sectors, but there's still overall inflows.
It's broad-based because of what fixed income is doing, because of what synthetic income is doing, leverage, right? All these, as our friend Eric Balchunas calls them, hot sauce ETFs, right? That's contributing. Equities have been strong, but so is everything else.
Yeah. On top of that, international's not getting much love this year, but there's a small group of international ETFs at new highs. Mr. Modi, the Prime Minister of India, was in New York recently meeting with tech executives. So the India ETF is at a new high there. That's several different ways. INDA is the biggest one, I believe, that's out there. That market's at a new high. I see Singapore's at a new high, South Africa, Thailand, sort of a disparate group. And the Vanguard Emerging Market ETF, surprisingly, at a new high.
So India has been a beneficiary of the blow-up in China. Right? 32 years, 0% return, immense volatility. Investors have finally decided, I've had enough, which maybe that means it's the bottom for Chinese equities. But India has now taken that huge weight disparity and evened it out with China in the emerging markets ETFs. And it's a new growth play. it's simply put a growth play. There's plenty of tech there. There's plenty of consumer discretionary to get involved. The cyclical type of environment that investors are attracted to, while China figures out whatever.
Yeah, and there's all sorts of debate about whether India really can replace China. Given how advanced China's infrastructure is, India is still relatively primitive, and yet the market doesn't seem to have any problems throwing money at it.
There. I think that's also a derivative of reshoring, right? Manufacturing moving out of China, and they're going to India, where companies can now build that up. And the idea being that that market can benefit from it.
Yeah, there's an avalanche of cash going into fixed income as well. Fixed income is getting inflows. As the cutting cycle progresses, you might think, why so much money going into fixed income with the cutting cycle? Well, money markets fund, the futures market says money market's going to have a 3% handle. Now, I know some of you are getting 5% right now, but next year, it seems they're anticipating 3%, yet the money's very sticky.
The $6 trillion, of which $2.5 trillion is in retail money market accounts, is the most fascinating psychological experiment in this industry right now, because that 5% is going to evaporate real fast if the pace of cuts continues. And so I think a lot of that retail money is going to go to fixed income ETFs, because there's over 700 fixed income ETFs now. You can get any sort of yield, duration, credit risk you want, as opposed to, say, the cutting cycle in 2019, there were only about 300. And go back, there's less and less ETFs. So investors can get the product they want with very high precision, and so I think they're going to be a huge beneficiary. And you also have to remember, the ag has been in a bear market for 4 years, so a lot of investors tax loss harvested out of mutual funds, and it's all going to fixed income ETFs.
The ag being the general bond fund, the largest bond.
Right.
It's actually an index.
The benchmark that bond investors use.
Yeah.
The aggregate.
Just want to be careful about the jargon. The viewers don't all know all the jargon about that. Nick, give us your thoughts on inflows into fixed income. He's right. It is a fascinating psychological experiment. $6 trillion in money market funds. I can tell you for sure, the viewers are delighted with 5% yield on money market. If it stayed anywhere near, a lot of them would stay there forever and be perfectly happy, because they can smell they're getting, and I think it's fair to say, an inflation-adjusted positive return on that. And yet it seems like that's not going to last. Like I said, they're expecting within a year to be in the 3% range. Your thoughts on this?
I mean, I think that is a really, really interesting test case over the next couple of years, like you said, for investor psychology. $6 trillion in money market funds is an enormous number. People kind of fled there because of the rate situation. But I think there's kind of a consensus that as rates come down, they'll just leave as quickly. And I'm not sure that that's true. People got really used to 0% yields. And so while they're not going to get 5 or 6% for very long, 3% I think is still going to sound pretty good to people. It's interesting. We have benefited, I think, from the desire for investors to reduce duration over the last couple of years. We have the largest CLO product in the market. It's $12 billion in a AAA CLO product, and a lot of that money is from professional investors who are looking for yield in excess of money markets. And in the last week, 2 weeks, 3 weeks, as people knew rate cuts were coming and then they came, we've continued to see very strong inflows into that product. And if it was just about duration, I don't know that that would be the case. Now, it's yielding better than money markets, right? So people are definitely looking for extra yield, but I'm not sure that investors broadly, and particularly retail investors, are going to make a duration call as much as they want to ensure that they have adequate yields. And I think for a lot of people, 3% is going to feel pretty good for a while. So I definitely agree that the professional investor is going to start moving more and more into fixed income. And like every other cycle, when they go from money markets back to fixed income, they're probably going to pick an ETF over a mutual fund. But I have a feeling that the money sitting in money market funds, particularly retail, is likely to be stickier than people really expect.
Yeah, I completely agree. I could just tell you the email I get, even conversing with my mother, who's 95 years old, they just love it. And they feel it's a very good ballast to the stock market. They don't want the added risk. They're very comfortable. I've heard people have 10%, 20%, 30%, and money market funds seems pretty high to me, but they don't, the volatility for particularly the older demographic, that's the ones that tend to write to me, tend to say, I'm very comfortable here at this particular level. I think you're right, Nick. I think it's much more stickier than people think. And so in a sense, everybody's waiting for, are we going to get 1 trillion of that 6 trillion going to the stock market? They may be wrong on this.
I think you need a big bear market before it goes into stocks.
Yeah.
Right, like in 07, 2000, that's what happened then. I'm not so sure about it right now.
Yeah, I think so too. All right, fascinating discussion, everybody. I know we've moved around a little bit, but that's what you get when you get two great guys like we had today. That does it for this week's ETF Edge. My thanks to Nick and to Todd. We've asked Todd to stick around, provide us some additional perspective. I have other questions for this guy on where ETFs are going for the rest of the year. It's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.